In segment 2 here, we're going to start off with where we ended the last one, talking about some of the problems that remain within the U.S., especially when you start looking at the firm's most pressing concerns. Here you can see that monetary policy still remains a much bigger issue and it continues to be a much bigger concern. Same with cost pressure and inflation. And those two pieces, you'll be surprised to know, are quite linked and quite close together. And why that's going to continue to be the case, because we will see more pressure. We will see Powell maintain this level of tightness, because they need to see more liquidity get pulled out of the system. And one of the examples that we can use in this moment is just looking at, used vehicle value. So yes, we're gonna have more issues when it comes to the UAW strike, but you can see that without the strike and without all those pieces, year over year things have come down, but you're still up 40%. And this is what some of the inflation data misses. It's like, well, look at year on year, things are getting better. It's like, but you need deflation. You need to pull some of this cost out or this price out, and you're not going to get that unless you have a restrictive monetary policy and really more companies focusing and concerned on these core pressures so that they pull back investment, they slow things down, because you need to see some of this reduction and some of this inflation coming out of the market. Now, one of the key pieces is smaller companies are paying a record interest expense without a major boost from interest income. This is something that we discussed a couple of months ago when you start looking at the 70s and right now. So yes, interest rates were much higher in the 70s. You still had that interest rate increase, those elevated levels. But even when you had mortgage rates at 19, 20%, you had savings rates at 13, 14%. So yes, there was obviously still a delta or a difference, but it wasn't as extreme as it is today. I mean, when you look at some of the bigger banks, the interest expense that you're earning is peanuts in comparison to what you're paying out. And a lot of these companies that have a sizable amount of cash sitting in savings, the hope would be that they'd be able to take some of that interest and pay off some of their interest or offset some of their interest expense. And it just isn't there because a lot of these banks aren't paying that. And if they're all not paying it, well, then how do you force them to do it? And it's a lot of it is because they've mismanaged their own portfolios so much. But this is becoming a much bigger pressure point because it's getting harder and harder for companies to offset this, which is why we do expect to see a sizable change in investment, especially when you look at, again, the rate of change. The rate of change is the most shocking piece when you're looking at a CFO, a treasurer, a controller that's trying to manage their cash flow system. And a lot of these companies are finding themselves cash strapped or liquidity constrained because of some of these different shifts. Now, when you just look at some of the quotes here, this is a new uncharted territory for small caps, adding the smaller companies face the prospect of either rates staying high or the economy heading into recession. Small caps have broadly weaker balance sheets than their larger counterparts. Debt as a multiple of profits is higher, and interest payments take up larger share of earnings. Crucially, 30% of Russell 2000 companies' debt stock is floating rate, exposing them to a rising rate environment. That is in contrast to 6% of this S&P 500. More small companies tend to rely on bank lending, which has grown very restrictive. Smaller companies tend to have more competition and less pricing power, which pressures margins as inflation stays high and wages increase and as growth slows. Again, this amplifies that delta, that problem, and that's going to see a much bigger margin squeeze when we look at some of those corporate profits. Bloomberg consensus shows relatively large jump in probability of a Fed rate hike. That's something that we still think November is going to have that rate hike. I know others are saying, well, because of how things have changed, because of the market in general. Realistically, I think the bond market, and we'll talk about how that has shifted down, is pricing in that last increase. And this movement that we've seen in commodities, in rates, in equities, is pricing in that last piece to see that again. And then what our baseline is, we will stay at that level for at least 12 months, which means that we won't see a cut until at least November of next year. And again, that's where we continue to see some of these pressure points. And this is one of the key pieces. And the reason why we're going to talk about the 10-year the most is because the 10-year is really kind of the bellwether that emerging markets price themselves off of. Because realistically, do you trust an emerging market with 10-year paper or 30-year paper? So normally the longer end is the 10-year side. So it's a big piece of, how are they going to finance? How are they going to, what spread are they going to use? Because if you're going to give in the U.S., let's say that you're going to say 4.75% U.S. 10-year, are you going to give Nigeria money at 6%? No, is it 18, 25%? But you're going to use this as a starting point and then assess the risk on top of that. And that's why we see the not only the rate of change, which has essentially turned people upside down, because again, the mismanagement on the hedging front has created duration risk at the bank, where the banks are now essentially carrying paper that is worth much less, which is why you've seen them go upside down on cash flows, because remember, yield and price are inverse. So as yields are going up, it's because prices are coming down. So if you're a bank that bought in at 102 of par that is now trading at 97 on par, you lost a lot of money. And that's something that is becoming a much bigger issue, especially if you have debt that is international debt where you wrote some sort of structure utilizing essentially a much weaker assumption. And that's why when we talked about this back in, for those that have known me in 16 and 17, you had people giving Nigeria debt at 8%. It's like, but what happens when rates go up? And the comment was always, oh, rates are never going to go up. It's like, no, it's because they haven't gone up in a while. Doesn't mean they're never going up. It just means that it's going to take a more cataclysmic event to make them move. And the problem is that cataclysmic event creates this massive rate of change, which if you don't get in front of it, you end up getting left behind and then struggle trying to catch up and right-size your portfolio from a banking perspective, but also from a corporate perspective as well as an investor perspective. So then the 30-year mortgage rate climbs above 7.5%. So it's the lowest, the index of mortgage applications for home purchases. It's the lowest since 1995. Again, highest mortgage rate since 2000. The problem is home prices. You have home prices that are remaining elevated. So that's where you're seeing this kind of upside down housing market, which the only correction that you can really get in terms of adjusting affordability is to either bring down rates, which in our opinions isn't going to happen, or bring down home prices. But home prices are very emotional and that takes time. And especially when you have people who are sitting there and being like, well, I just bought this home. It's probably 20% underwater on an equity basis, but I have a 3% mortgage. I'm not moving unless they force me to. So the other side of the equation is a lot of these people are sitting on a lot of credit card debt. So when you look at personal bankruptcies going up, that pulls in the home, which is going to, again, create additional shifts, if you will, in terms of volume, as well as when does Airbnb and Vrbo holders liquidate those investment homes. There's a lot of pieces out there that can start to kind of knock down and bring down that home price, which is really what I think Powell and the Fed wants to see. And this just puts into perspective the delinquency rate on credit card loans, banks not among the 100 largest in size by asset. It doesn't take much, because you might say, Mark, it's only 7.5%. And you'd be right, but 7.5% of how much money? And how much, typically is it somebody who has a balance of, $1,000 and can't pay, therefore their delinquency rates? Or is it somebody that has 100,000 or 400,000 on their credit card and are now delinquent and are compounding at a 22% rate? You get an idea of where this sits, and a lot of this is at the smaller banking side. Now, the cumulative number of small business bankruptcies each year is continued to rise when you look at 2020, 2021, 2022, and now 2023, the acceleration is there because of the cost, because of the level of extensive pressure points when you look at the underlying market. And again, the ability to get debt or the cost of getting debt. At this point, a lot of these companies are like, look, we have to go into restructuring, whether it's Chapter 11 or Chapter 7. Will be decided at the legal level, but this is again those pressure points. But who has the most exposure to some of these small businesses? Asset exposure by bank size. When you look at small, all banks outside of the top 25. When you look at residential real estate, 21%, consumer 10%, commercial real estate is 44%. You know, how many of those small businesses had exposure to commercial real estate? How many of them were companies focused on that? When you look at this reduction in real estate, especially on the commercial level, it's the small banks that are the outsized exposed to what is going to happen. U.S. commercial real estate prices expected to keep sliding. You know, when will U.S. commercial real estate prices bottom? 44% of respondents said, excuse me, the second half of 2024. Do banks have the ability to last that long? And what does that price slide look like? Is it something that's going to be precipitous? Is it something that's just going to be kind of gradual? And this is where banks are struggling with what is their collateral backdrop, especially when you look at the market in general, which has seen a structural shift in how people are utilizing the office or not utilizing the office at this point, putting an undue stress on the banks. So then banks' unrealized losses are quite large. When you look at securities available for sale, securities held to maturity, we're at losses that are approaching about just approaching 600 billion. Total unrealized gains losses as a percentage of bank equity is sitting at about 25% loss. Now, some banks can handle that. You know, they've factored in a right sizing or a write down of 30%. But some haven't. And the issue, the reason why, because you might say, well, Mark, don't they do stress tests? Well, yes. But for some reason, the Fed never stress tested an increase in rates. Instead, it was always decrease in rates or liquidity tightening up. Nobody thought about what happens when the bond bull market actually ends. And again, the percentage chance of it happening was quite low. But as the bull market continues, it runs its course. And as much as people say, oh, we've broken the cycle, this, that, and the other thing, no, you haven't. You held back the invisible hand, which is now going to come back around and correct some of these issues and essentially putting to task a lot of these companies and banks that have mismanaged their duration risk, their hedge risk, which is going to create more problems in the real estate market as you get these forced liquidities. Credit contraction continues. Bank credit is officially contracting, and this hasn't happened during the financial crisis. And again, these are things where we continue to show some of these pressure points. And then through the end of September, Fed's discount window and bank term funding program usage continued to inch higher, showing pressure at the more on the small medium bank side, which, as we've seen, they do have more concerns and more reasons to try to find ways to offset some of their problems. Then when we start looking at the junk bond credit spread versus the MOVE index, the MOVE index continues to push higher, but yet you're still seeing spreads staying fairly reserved. And that's something where we see more problems and a catch up. And you can see on the credit spread side, it can catch up all at once. And that's the rate of change that we're talking about that we've started to see in other places and issues that we continue to see. So a potential blowout in credit spreads remains one of the most compelling macro trades at the moment. Despite the issues in the fixed income securities worldwide, corporate high yield spreads appear to be unsustainably suppressed. A widening of credit spreads is likely to develop next. And again, that's the next piece to happen, which is where we do see that happening. We actually think it's going to happen much sooner, given the length of time that things have been unsustainably depressed. And it's going to come from a lot of these liquidations and a lot of this forced sale, which we're going to continue to see. All the while, the U.S. national debt has now increased by over $2 trillion since the debt ceiling was suspended just 4 months ago. And it's a compounding problem because now interest rates are going up, interest expenses going up, rolling is happening. And again, this compounding problem makes the additional debt just happen much faster, which is what we've been saying. It's like eventually spending will stop. Whether it's you get in front of it because of this, or you let this run its course until spreads blow out and people just stop giving you money and you have a failed bond auction. These are things that are real, especially when you start looking at the seizing up in the collateral markets, which we're starting to see which we've seen not only in China, but also in Japan, and now are bleeding into Italy, which is going to become a much bigger issue. The financial conditions started to tighten once again after kind of being a bit lackadaisical. And when you look at the U.S. market implied change in the overnight rate, you've seen that since October, you've seen an increase in expectation of a rate hike. And I think that people are starting to see that, and again, pricing that into the market at this point in time. Prices paid component of ISM Manufacturing and Services continued to go in different directions. When you look at the service side, prices went back up, and again, putting a bit more pressure on the service front, especially on the inflationary side. Manufacturing a bit lower, but remember, services is 70% of the market. So yes, manufacturing got cheaper, but the more important one, or the one that impacts more of the spending in the U.S., actually went back up. Initial jobless claims rolled back over, but USA workers affected by WARN notices in 12 big states have gone up. So again, you're starting to see that pivot, but it's taking a long time because of the lack of participation, because of these issues, which is going to keep the Fed active and keeping those rates elevated. Companies are talking more about theft. When you look at the inventory shrink, this puts into perspective just the amount. So from Q1 of last year to Q2 of this year, the retail shrink has increased 304%. It's why you're seeing companies close stores. And then again, you're just seeing a changing of the guard. New SPACs to debut have had hit a standstill. For those that have been following us, we refused money back in 2021 when we said we didn't want to do a SPAC. We thought it was a failed way of doing things, or at least one that was going to cause more scrutiny. It would be very easy for the individual who was offering us money to go out and just essentially paper the town and leave everyone in the lurch. And so we decided not to do it. And here you're seeing that become a much bigger issue. And I know you might be thinking, like, why are these on the same page? And it's just looking at some of the inherent problems that remain in the system on different levels. One is inventory and stealing. The other is stealing, but in a more white collar way. But they're both showing the pressure points and how things remain to be kind of adrift when you look at how the market is looking at movements. Real disposable personal income contracted by 2% in August, marking the third consecutive decline, which hasn't happened since late 2021. And again, that's where we see more disposable income slowing, and that's why people have relied more on spending, using credit cards, which we continue to see. And then with the revision in Q2 of services, spending was weaker than initially thought. 1% quarter-over-quarter gain was weakest since 2020 recession. And as those that have been following us, we think it gets worse in Q3, and that actually continues to compound into Q1 of next year. Buying versus renting, just putting into perspective the cost to buy, the cost to rent against the 1970s, you get an idea of just how impactful this massive liquidity dump was. Why the Fed was buying mortgage-backed securities is still beyond me. As you can see, there was pretty much nothing showing that there was a slowdown. And even if they said, look, we want to do everything we can in 2020, fine. Why they continued this through all of 21 and into 22 is still beyond me, given the pressure that they caused. And this has to unwind. And the only way this can really unwind is by keeping those rates elevated. Card spending data has dropped sharply, pointing to the downside risk to September retail sales. You know, as we've been saying, we saw this compounding, and you can see it hasn't gone negative, but you get an idea of the problem and the pressure points in general, where it's the rate of change. You know, yes, as we said, it kind of started to roll over in July. It got a bit worse in August, and then September, and we see this continuing, especially as the PCE inflation expected to be at 0.5 came in at 0.4. People call that a win. I just see another month-on-month increase that is going to hit the consumer once again, reducing those sales even further. Job openings rate for leisure industry ticked lower in August, but both durable and non-durable good industries increased. Again, kind of flatlining. Relatively good news within August JOLTS job openings report was that level of layoffs was virtually unchanged. Again, you kind of get this balancing act of people trying to manage their current systems. September job cuts up 58% year on year versus 267% in the prior month. So again, just, you know, you're still not seeing the big shift or the big adjustment in labor that the Fed would actually want to see. Even though job openings ticked up in August, the ratio of openings to number of unemployed individuals, which is watched by the Fed, ticked slightly lower. But as you can see, going back to 2001, you're still at a very elevated level. So there's still nothing showing that this has to reduce or this has to slow. And then the per JOLTS data, job openings increased by 690,000, largest monthly gain since July 2021. So again, that's what we have for you today on this front. In the next segment, we're going to go deeper into the consumer, housing, real estate, but also some of the key leading indicators showing how things continue to slow. Not so much where they're in steep contraction, but in the U.S., you know, we're moving in the wrong direction when you look at growth.